Every financial advisor on earth will tell you the same thing. Diversify, hold bonds, keep cash, and trust the system. For most of the last century, that advice wasn't wrong, but there is a number nobody on mainstream financial television wants to say out loud: 97%. That is how much purchasing power the dollar has lost since 1913. It didn't happen in a single crash or one dramatic collapse. It happened slowly, quietly, and by design. Right now, something structural is shifting. BRICS nations settled over 65% of their mutual trade outside the dollar last year, and central banks are buying gold at the fastest pace recorded since 1967. The dollar isn't dying yet, but 5 specific asset classes are about to absorb the damage. The first asset you must consider selling is long-duration U.S. Treasury bonds. For 70 years, the U.S. Treasury bond was considered the closest thing to a religious relic in finance: safe, stable, and guaranteed. Here is the dark truth. In 1946, the British pound was also considered indestructible. At the end of World War II, Britain held the second largest reserve currency on Earth. By 1976, bondholders who had held 20-year gilts watched the real purchasing power of their principal evaporate by over 40%, while being told they had been paid in full. The mechanism that destroyed sterling bondholders is the same one currently targeting dollar bondholders: financial repression. When a government's debt becomes too large to repay in real terms, they engineer a quiet theft. They keep interest rates below the real rate of inflation for an extended period. You receive your interest and principal, but that money buys significantly less than it did when you lent it. With U.S. national debt crossing $36 trillion and interest payments exceeding defense spending, the math eliminates real options. If you buy a 30-year Treasury today and inflation averages a conservative 4 to 5%, your real return is deeply negative. You are locking money into an instrument designed to return less value than it received. The second asset to exit is dollar-denominated pensions and fixed annuities. This is the one that should anger you most. Most people think of their pension as a personal savings account, but in reality, your pension fund is the U.S. government's single largest captive buyer of the exact bonds that are eroding in value. Under global banking regulations like Basel III, pension fund managers are legally obligated to hold a certain percentage of their portfolios in these instruments. It's not because they think it's the best investment, but because the law requires it. Hundreds of trillions of dollars in retirement savings are mandatorily parked in the asset class most exposed to dollar debasement. Consider the fixed annuity. You hand an insurance company a lump sum and they promise a fixed dollar amount every month for life. The dollar amount never changes, but the purchasing power does. If inflation runs at 5% annually, a fixed annuity loses half its real value in just 14 years. Unlike a bond, you cannot even sell the annuity at a discount to cut your losses. You are locked in. The asset is not a guarantee, it is a bet on currency stability dressed in the language of certainty. The third asset class involves dollar cash deposits and high-yield savings accounts. After a decade of near-zero interest rates, banks are finally advertising 5% yields. For savers, this feels like a gift. However, if you run the actual math, the picture changes. Independent measures of inflation consistently show real-world price increases running much higher than the official CPI. If real inflation is closer to 5 or 6%, a savings account yielding 4.5% has a negative real return. This is even worse after you pay taxes on the interest income. Your account balance rises, but the lifestyle it can fund shrinks. We must also remember that a bank deposit is not a vault. It is a loan you make to a financial institution. The speed of the Silicon Valley Bank collapse in 2023 demonstrated that the safety of bank deposits is contingent on confidence, which can evaporate in an afternoon. Cash in a dollar deposit account is not a safe haven. It is a slow leak. Fourth, you should be wary of domestic-only U.S. technology stocks with zero hard asset backing. Not all equities are equally vulnerable, but a specific class of American software companies is at high risk. These are companies that derive the vast majority of their revenue domestically, have no physical assets like factories or land, and are priced entirely on future earnings projections denominated in dollars. Their valuation assumes that dollars will maintain purchasing power and interest rates will stay moderate. If the dollar loses 30% of its real value over a decade through controlled inflation, the real value of that company's future earnings is reduced by 30%, even if the nominal stock price rises. Furthermore, many of these companies were valued during the period of near zero interest rates. When the discount rate rises to reflect real inflation, the present value of those distant future earnings collapses. A portfolio heavy in domestic technology stocks with no international revenue and no hard assets carries a structural vulnerability that most investors have not priced in. The fifth asset is leveraged residential real estate in overvalued dollar markets. This isn't a warning against all property. Agricultural land and diversified commercial real estate often retain value. The danger lies in leveraged residential homes in metropolitan markets that have seen 40 to 80% price appreciation since 2020. In a dollar reset environment, mortgage rates stay elevated, and the pool of buyers who can afford a $1 million home shrinks dramatically. Simultaneously, as the dollar loses reserve status, foreign institutional buyers reduce their exposure, removing a major source of capital from the market. The result is a market where nominal prices might stay flat, but real prices measured in purchasing power decline significantly, while the asset remains illiquid. Every dollar of your income goes to service debt on an asset that is losing real value. In every financial collapse throughout history, the people who were destroyed were not stupid. They were just following the rules of the previous era with perfect discipline. The Roman centurion who saved his denarii for 30 years wasn't a fool. He just didn't realize the system had changed around him. The 5 assets discussed here were the right tools for a specific monetary era, but those foundations are shifting. What survives a currency reset is consistent, hard assets with intrinsic value independent of any government's promise. Gold, productive land, equities with real assets and international exports, and skills that serve human needs. The question is not whether the dollar will lose value, but which assets will absorb that loss silently while you believe you are safe. Now you know the answer.